Hey everyone, today I want to talk about situations when you have no idea which way the market or specific stocks are going to go, whether they're going to go up or down, which can be challenging for stock traders. But for options traders, that's not a challenge at all. And I'll show you why. So you're watching my daily trade log, and today is my trade number 226. But before I talk about that, let's talk about my trade from yesterday. If you haven't watched my video, then click on the link above. It's only a short video and it's definitely worth it. So what I did yesterday was an earnings play. I sold a strangle. Selling a strangle means selling a put option and a call option at the same time, expiring at the same time. And I did this on AA, which is Alcoa. Alcoa had earnings after the close yesterday, and normally what happens is before earnings, the volatility is elevated. But we're living in a very strange environment where sometimes the volatility is not actually elevated at all before earnings. And that was the case with AA, but I still took my chances. I still believe that there is going to be a volatility crush. And if you look at this bottom chart, you can see a red line and a green line. The red line indicates the high of the volatility for the given day, and the green line indicates the low. And yesterday, when I sold this strangle, the volatility was just over 19. As you can see, it's pretty low. Recently, it was all the way up to 80 plus. But still, earnings came out, and after earnings, normally you can expect a volatility crush. And as I expected, it did happen. Today, the volatility dropped below zero. It's at -10. Now, how does it get to -10? That's because in recent times, the volatility has not been so low. That's why it gets to a negative number. But tomorrow, that number should be over zero. So with this particular trade, I had no idea which way the price is going to go. And if we zoom into what happened, the stock dropped from 53.45 of the close all the way down to 49.52. And it did not affect me at all because the volatility dropped a fair bit. So I was able to close this deal. I sold it for $1.20 and I was able to close it for 0.85, and that's an annualized profit of 2,388. Now, if you're not happy with 2,388% annualized profit, then something is wrong with you. So let's talk about my today's trade. Today's trade is quite different. I have actually placed a directional play on CarMax, which is CarMax. As we can see over here, once again, if we look at the volatility, it's very low compared to the historicals. If we zoom out a little bit, normally the volatility is more around the 60, but today it's at 26.6. And you can see that the volatility is fluctuating quite nicely. So that's quite predictable. And what makes the volatility spike is actually the earnings. So you can use this for your benefit. Now, at the moment, the volatility is very low. So selling a strangle is not necessarily a good idea because we can expect the volatility to go up. And if you sold a strangle and the volatility goes up, then you're going to be losing money, even if the price doesn't move at all. But if you look at the daily chart of the actual price, and you can see that the $55 level, which is where I had my strike, has only been tested or breached back in December on the day of earnings since COVID. So I'm quite comfortable that the stock is going to stay above $55. And in the last couple of days, it went all the way up to 70, almost 71. And now it's sitting at 62. So I am a little bit bullish on this one. I'm not expecting it to be a quick trade, but who knows? Maybe tomorrow we'll see a nice bounce and I'll be able to close this position. So what did I sell? I sold the February $55 put option. The market is not really good. The spread between the bid and the ask price is a little bit wide, but I was still able to collect 95 cents credit for it, and it only consumed $558 of my buying power. So that's a great potential return. So if I hold it till expiration and the stock stays above 55, then I'll be seeing a 214% annualized return on this one. But I'm not expecting it to hold it for that long, and I'll show you why. If I look at the daily chart of this particular option, then you can see that yesterday the low was at 35 cents. So I sold it today at 95. So hopefully tomorrow I'll be able to close it. I had an auto close on it at 66 cents. So it's not going to make me rich, but the more of these kind of trades you do, the more money you're going to make, and it's an exponential growth. Now, I also closed a couple of other trades. They were also really good ones. One of them was Marvel. So I sold a strangle against this one, 32.50 put and the 45 call. I sold it on the 10th of January, so 9 days ago, and I sold it at 130 and I closed it at 83 cents. So the annualized profit is also very, very nice on this deal. And the third one that I closed today was Wayfair. Once again, it was a strangle, a 30 and 55. So the 30 is the put, the 55 is the call. And I sold it for $2.03 and I closed it at $1.40, and that's an annualized profit of 447. So if we just take a very quick look at Wayfair, then you can see that once again the same story, the volatility. So when I opened that trade, that was on the 13th of January, which is, if I zoom in a little bit, 13th of January right here. So the volatility was a little bit higher than today, and that's the reason why I was able to close it within a week. So that's how you can take advantage of the volatility when you have no idea which way the price is going to move. You just focus on the volatility, and I can almost guarantee you that it's going to work out, unless something is terribly wrong with the underlying that you're trading. So this wraps up my trade number 226. I hope you enjoyed it. I hope you find it useful. Hit the like button, subscribe to my channel, and spread the word. Thank you for watching.